The logic behind the size factor. Do logical risk-based explanations exist for the size premium, or does it just appear out of thin air? Unlike the lengthy and debatable explanations for the value premium, simple reasoning makes the size premium easier to comprehend. Small-cap stocks are exposed to more risk because, compared with large companies, small companies typically have a narrower capital base, more leverage, higher volatility of earnings, lesser ability to withstand economic downturns, lower profitability, more restrictive access to capital, less liquidity, more uncertain cash flows, less experienced management, a new and unproven or less proven business model. Research indicates that from 1927 through 2022, the annual standard deviation of small-cap returns 30% was 50% higher than that of large-cap stocks, about 20%. This makes small-cap stocks more volatile or risky than large-cap stocks. Moreover, smaller companies are more vulnerable to losses from poor macroeconomic conditions. For example, the CRSP 6-10 index of small-cap stocks lost 50.2% in the Great Depression of 1931, which was the single worst year for the US stock markets. By comparison, the CRSP 1-5 index of large-cap stocks lost 43.3%. A similar trend is observable during the recessions of 1973 and 2008. Small-cap stocks lost more value than large-cap stocks in both. Several authors have studied the correlation between the size premium and the economic cycle risk. In their 2002 paper, Gerald Jensen and Jeffrey Mercer found that significant size premium exists only when the central bank has an expansionary monetary policy. The premium becomes statistically insignificant during periods of restrictive monetary policy. Moon and David Burney corroborated these findings. They concluded small companies grow faster than large ones in good economic times, but do poorly during economic downturns. The size premium is therefore the compensation for the procyclical tendency of small-cap stocks. Motihiro Yogo reached a similar conclusion. The above examination offers sufficient risk-backed rationale for the size premium. However, we must address something before completing our treatment of the size factor: the small-cap growth anomaly.